You've worked hard, you saved, you invested. But with inflation rising and recession fears everywhere, you're probably wondering, am I about to lose it all? But here's the thing, the people who build wealth during recessions, they don't panic, they prepare. And that's exactly what this video will help you do today. Hello, I'm Jonathan from Parent Portfolio. My wife and I once had over $250,000 in student and personal loan debt. And although we had solid jobs, we still felt broke. We didn't grow up learning everything about money, but everything that we know today, we had to figure it out the hard way. Now we built a 7-figure net worth, and we help others try to do the same. So if you're new here, and you want more videos that help you grow wealth without feeling overwhelmed, hit the like button, subscribe to the channel, and tap that notification bell so you don't miss any of our updates. So most people feel on edge right now, and for good reason. The stock market's swinging like a roller coaster. Inflation won't back down, interest rates are sky high, and now recession fears are back on the table. Even the CEO of JP Morgan said it, a US recession is now likely. I lived through a recession before. Back in 2008, I watched friends and family members lose their jobs. I saw home values collapse, and I had no clue if things were going to get worse. So now, with another recession looming, I want to share the exact lessons I've learned and what I'd do differently if it happens again. Remember, this isn't financial theory. This is what I lived. And more importantly, it's what you can do to protect your money, find opportunities, and come out stronger. So, how did we get here? Before 2025, things look great. Back-to-back years of 20% plus returns in the S&P 500 had everyone feeling so good. But now, aggressive tariffs, rising inflation, a global economy still trying to stabilize. Now we're seeing a negative GDP forecast. Big banks like JP Morgan and Goldman Sachs are saying that there's 45 to 60% chance of a full recession. And consumer confidence, it's falling very fast. So what does that mean for you and me? It means to stop reacting and start preparing. So let's zoom out a little bit. I've always loved market history, not because I'm a personal finance superfan, maybe, but because it gives perspective. In 1987, Black Monday wiped out 22% of the Dow Jones in one day. And then came the dot-com bubble burst, early in 2000, where $5 trillion vanished. And of course, the 2008 housing crisis nearly collapsed the global economy. I still remember my mom watching the news worried if she'd lose her job. And to be honest, I just started a new job and wondered if I'd still have one at the end of the year. But here's what happened after those crashes. After 1987, a bull market that grew over 580%. And that dot-com burst, a full recovery within a few years. After 2008, the market quadrupled over the next decade. So what's the big takeaway here? Every crash hurts, but history shows the market recovers and rewards those who stay in. Here's a lesson I wish I learned sooner. Trying to time the market can ruin your returns. Studies show that missing just the 10 best days in the market over 30 years can cut your returns by more than half. Remember, time in the market beats timing the market. It's just not a catchy phrase. It's backed by data. When I first started investing, I was constantly checking apps, panicking at every red arrow. But over time, I learned to zoom out, stay consistent, and stick to the plan. That shift helped us grow our net worth to over $1 million into our 30s. Not only through luck, but through discipline. So here's what most people don't realize. In about 30% of years, the S&P 500 dropped somewhere between 10% and 20%. And in 16% of years, it falls by more than 20%, a full-blown bear market. In other words, market drops aren't rare. They happen almost every other year. Volatility isn't some weird glitch in the system. It is the system. But here's the part that no one talks about. Most of the long-term gains in the stock market come right after those drops. Because while fears make headlines, it's patience that holds and builds portfolios. When the market dips, it doesn't mean you're doing something wrong. It means you're doing what long-term investors do. You're staying in, even when it's uncomfortable. Let me put it another way. If the stock market were a theme park, volatility would just be a roller coaster. Scary? Sometimes. Predictable? Absolutely. But people who scream and jump off mid-ride, they miss the payoff at the end. That's why your job as an investor isn't to avoid the dips. It's to stay calm, consistent, and committed, especially when things get shaky. When you embrace volatility as part of the journey, you stop fearing it, and you start to use it to your advantage. When we were still deep in debt, the idea of throwing big chunks of money in the stock market felt very terrifying. What if I picked the wrong time? What if the market crashed after I invested? So instead, we started small. $100 here, $200 there. Every single month, no matter what the headline said, we invested. Rain or shine, red days or green days, we kept investing. This strategy is called dollar cost averaging. And honestly, it saved my sanity and my portfolio. Here's why it works. When you invest the same amount consistently, you automatically buy more shares when prices are low and fewer when prices are high. It's like buying on sale without needing to time it perfectly. Over time, this evens out your cost basis and helps you avoid the stress of trying to guess the market. And more importantly, it removes emotion from the equation. You're not obsessed about refreshing your stock charts. You're not hesitant every time there's a dip. You're just following the plan. Think of it like a workout routine. You don't need to lift the heaviest weights on day one to see results. You just need to show up and be consistent. And over time, the results compound. That consistency can help you grow your net worth past 7 figures. Not luck, not timing, just small, steady, repeatable wins. So, what can you actually do right now to protect your finances and maybe even come out ahead? Let's break it down. Step 1, build or rebuild your emergency fund. Before anything else, your number one defense is cash. Aim to set aside at least 3 to 6 months worth of living expenses. And just don't leave it sitting in a regular checking account. Put it in a high yield savings account where it can grow quietly with better interest while staying easily accessible. This isn't just about emergencies, it's about a peace of mind. When you know you can cover a few months of expenses without touching your investment, you make decisions from a place of stability and not fear. Start small if you need to. $20, $50, or $100 a week. Set up automatic transfers so it builds consistency without you even having to even think about it. Step 2, don't panic sell. When the market drops, your gut might scream, but here's the truth. Panic selling is one of the fastest ways to lock in a loss. Historically, the investors who stay in the market, even during recessions, end up doing better than those who try to time it. In fact, some of the best days in the stock market happen right after the worst ones. And if you miss just a handful of those recovery days, it can drastically reduce your long-term returns. So what's the mindset here? Zoom out. Stick to your plan. If your investments are diversified and aligned with your goals, trust the process. Step 3, look for buying opportunities. This is where your long-term mindset gives you an edge. Think of a recession like a giant Black Friday sale, but for the stock market. If you believe in a company or an index fund last year, and there's nothing fundamentally that has changed about it, why not buy more? Recessions are when great businesses go on sale. It's when the best investors, those who built generational wealth, quietly add it to their positions. Remember, don't chase hype. Don't try to pick the bottom. Just keep investing and lean into dollar cost averaging to make the most of down markets. And remember the words of Warren Buffett: be fearful when others are greedy, and greedy when others are fearful. It's not about being reckless. It's about recognizing that fear creates opportunity if you're prepared. Look, I get it. Volatility isn't fun. Watching your investments drop is gut-wrenching, especially when you work so hard to build what you have. But here's the truth. Downturns are temporary. Wealth is built by people who stay steady when everyone else is panicking. So take a deep breath, make a plan, and stay consistent. Whether you're just starting out or have been investing for years, you don't have to fear a recession. You can prepare for it. And if this video has given you clarity or even encouragement, please hit the like button and subscribe to the channel if you haven't already. And if you're ready to take on the next step further, and if you want to create your own financial game plan, apply for our financial coaching program. We'll help you protect what you've built and stay focused no matter what the market does. The link is in the description below. Once again, thanks for watching. You've got this, and I'll see you in the next video.